Hi friends, today we are going to discuss about money supply and interest rates. So the money supply changes the interest rates. Let's look at it how. Supply of money is determined by the central bank, and central bank knows what the demand for money, and they can manipulate money change in many ways, and as a result interest rate changes. So let us look at with an example in a graph how it works out. So let's say this is the y-axis which is interest rate, and the x-axis which is quantity of money supplied by central bank. So for example, this is the demand curve for the money supplied, and let's say the money supplied by central bank is this. Let's say this is the quantity 1, which is money supplied by central bank, and this is the current interest rate, let's say IR1, at this point of equilibrium. So generally supply of money is perfectly inelastic and it doesn't respond to interest rates, rather controls the interest rate by controlling the supply of money. That is the reason we see the supply of money here is perfectly vertical. So here you have central bank has two different kind of monetary policies. So one is contractionary and second is expansionary monetary policies. So what is this contractionary monetary policy? So if central bank reduces money supply, let's say the money supplied is at this level now, which is Q2. Now if you see the equilibrium point and the interest rate here at this quantity, let's say this is IR2, the interest rate has increased here. So when central bank does this contractionary monetary policy, the interest rate is increasing. So why the interest rate is increasing? Because there is a shortage of funds in the market, because the quantity supplied has reduced from Q1 to Q2. So when there is a shortage of money, the interest rate obviously increases because the demand is to meet the demand in the market. So in other way, number of people that are going to take loans will also reduce, and the investments also goes down, and then because of this the GDP also goes down. So now let's look at expansionary monetary policy. So where central bank has decided to increase the quantity, that is Q3, and now you can see the equilibrium point. Now the interest rate is reduced. So why interest rate is reduced? Because there is a increase in the funds in the market from Q1 to Q3. So when there is an increase in the funds in the market, you have lot of surplus, and hence the interest rate is coming down, so that more number of people can afford to take loans, and then invest money, and thereby the GDP goes up. Friends, this is all about money supply and interest rates. Thanks for watching. Like, share and subscribe, and leave comments in the comment section, and press bell icon if you want to watch my latest videos. Thank you.